Imagine waking up tomorrow and finding out that gold just hit $5,000 per ounce and silver exploded to over $300. Sounds crazy, right? Well, Bank of America's top metals analyst just released a report that makes this scenario more real than you think. If you're holding precious metals or thinking about it, the next 15 minutes could change your financial future forever. I'm here at Bullion Logics, and before we dive deep, smash that subscribe button and hit the bell icon, because what I come about to reveal will blow your mind. Let me start with something that should make every investor sit up and pay attention. On January 5th, 2026, Michael Widmer, the head of metals research at Bank of America, one of the most respected financial institutions in the world, published a groundbreaking report. This isn't some random prediction from a YouTuber or a self-proclaimed guru. This is Bank of America, an institution managing trillions of dollars in assets, telling the world that gold will average $4,538 per ounce in 2026. But here's where it gets absolutely insane. Widmer didn't just stop at gold. He stated that silver, often called the poor man's gold, could potentially reach between $135 and $309 per ounce. As I'm recording this, silver is trading around $90 per ounce. That means we are potentially looking at returns of 50% to over 300% on silver alone. Now, I know what you're thinking. You've heard bold predictions before. Every year, someone comes out with outrageous price targets that never materialize. I get it. I'm skeptical too. That's exactly why I spent the last several days digging through data, cross-referencing sources, and talking to industry experts to verify every single claim I'm about to share with you. Everything you hear today is backed by real data from credible institutions, not speculation or hopium. Let's start by understanding why Bank of America is so bullish on precious metals right now. Widmer's analysis isn't based on a single factor. It's built on multiple converging trends that are creating what he calls a perfect storm for gold and silver prices. The first major driver is supply constraints. According to Bank of America's research, the 13 major North American gold miners are projected to produce 19.2 million ounces in 2026. That might sound like a lot, but here's the kicker. That's a 2% decline from 2025. Production is actually going down, not up. And here's what makes this even more significant. Widmer explicitly states that most market forecasts for gold output are too optimistic. In other words, the market is expecting more gold than we're actually going to get. At the same time production is falling, the cost of mining that gold is skyrocketing. Widmer projects that average all-in sustaining costs will rise 3% to approximately $1,600 per ounce. For context, all-in sustaining costs include everything: direct mining costs, corporate overhead, exploration expenses, capital expenditures for maintaining production, everything. When you're paying $1,600 to pull an ounce of gold out of the ground, and that gold is selling for over $4,000, you've got massive profit margins. This is exactly why Bank of America expects gold mining companies to see their total earnings before interest, taxes, depreciation, and amortization, known as EBITDA, jump 41% to around $65 billion in 2026. Think about what this means. If it costs $1,600 to produce an ounce of gold and prices drop below, say, $2,000, many mines become unprofitable and shut down. This creates a floor under gold prices. The market knows this. Professional investors know this, and that's part of why there's so much confidence that gold won't crash back to historical lows. But supply and demand fundamentals are only part of the story. The real game changer is what's happening in the investment world. And this is where things get really interesting for anyone watching this video who's thinking about their portfolio. According to data from the World Gold Council, which tracks global gold markets, gold-backed exchange-traded funds saw record inflows in 2025. We're talking about the highest level of institutional buying since 2020, the pandemic year when everyone was panic buying safe haven assets. In the third quarter of 2025 alone, investor demand through ETFs, futures, bars, and coins totaled approximately 980 tons. That's over 50% higher than previous quarters. J.P. Morgan Global Research confirmed this in their December 2025 report, noting that quarterly demand hit about $109 billion at average prices of $3,458 per ounce. Here's what's fascinating. Despite this surge in investment demand, Widmer argues that the gold market is still underinvested. He made this point very clearly in his annual Outlook webinar in December 2025. He said, and I quote, "I've highlighted before that the gold market has been very overbought, but it's actually still underinvested. There is still a lot of room for gold as a diversification tool in portfolios." Let that sink in for a second. The gold market just had one of its best years ever. Prices are at all-time highs. And one of the top analysts at Bank of America is saying we're still underinvested in gold. How is that possible? The answer lies in understanding portfolio allocation. Whitmer's research shows that gold now represents about 4% of the total financial market. That sounds significant until you look at what high net worth investors, the really wealthy individuals and families, actually hold. Among professional investors and high net worth individuals, gold represents only 0.5% of their assets. Bank of America's modeling suggests that retail investors should have a gold allocation well above 20%, potentially even 30% in current market conditions. If you run the numbers since 2020, you can actually justify holding up to 30% of your portfolio in gold. Now, I'm not saying you should do that. I'm not a financial advisor, and everyone's situation is different. But the fact that a major bank is publishing research suggesting such high allocations tells you how serious they are about gold's role in modern portfolios. The traditional investment wisdom used to be the 60-40 portfolio, 60% stocks, 40% bonds. That's what financial advisors have been recommending for decades. But that model is being challenged right now. With inflation concerns, currency debasement, massive government debt levels, and geopolitical uncertainty, more and more institutional investors are questioning whether 60-40 is still appropriate. Whitmer's research indicates that adding significant gold exposure can actually improve portfolio performance and reduce volatility. Now let's talk about central banks, because this is where the story gets even more compelling. Central banks around the world have been buying gold at record levels. According to the World Gold Council's data released in January 2026, central banks added 45 tons of gold to their reserves in November 2025. That was slightly down from 53 tons in October, but still represents historically strong accumulation. In fact, central banks have been net buyers of gold for over a decade now, with particularly heavy buying since 2022. Here's the jaw-dropping part. Central bank gold reserves have now surpassed their holdings of U.S. Treasury bonds. Let me repeat that because it's crucial. Central banks worldwide now hold more gold than U.S. government debt. That's a massive shift in how these institutions view risk and portfolio diversification. On average, central banks currently hold about 15% of their total reserves in gold. But Bank of America's modeling suggests that reserves would be fully optimized with an average gold allocation of around 30%. That means central banks could potentially double their gold holdings and still be within what's considered an optimal allocation. If that happens, where do you think gold prices are going to go? Straight up. Why are central banks doing this? It's not some conspiracy theory. It's simple risk management. When you hold US dollars or treasury bonds, you're exposed to US fiscal policy, monetary policy, and political decisions. When tensions rise between countries or when there's concern about the dollar's long-term value, central banks want assets that aren't dependent on any single government. Gold fits that bill perfectly. It's been recognized as valuable for thousands of years across every culture and civilization. You can't print more of it. You can't devalue it with a policy decision. It just is what it is. The World Gold Council's 2025 Central Bank Gold Reserves Survey revealed that 95% of respondents believe global central bank gold reserves will increase over the next 12 months. This year, a record 43% of central banks expect to increase their gold reserves, which is the highest percentage ever recorded in this survey. Think about that. Nearly half of all central banks are planning to buy more gold. That's extraordinary demand coming from the most sophisticated financial institutions on the planet. Now, let's shift gears and talk about silver, because this is where things get absolutely wild. Michael Whitmer stated that while gold is a solid hedge and expected to perform well, silver may appeal more to investors willing to take higher risk for extra upside. The current gold to silver ratio is sitting around 59. That means 1 ounce of gold costs the same as 59 ounces of silver. Here's why that ratio matters. Historically, the gold to silver ratio has fluctuated dramatically. In 2011, during the last major precious metals bull market, that ratio hit a low of 32. If we see a similar ratio move and gold is trading at $4,500, that would put silver at approximately $135 per ounce. That's Whitmer's conservative estimate. At some point, the inventories will be depleted to levels where the market becomes extremely tight. When that happens, prices will have to rise to a level that either incentivizes new supply or destroys some demand. Given the time required to bring new supply online, the initial response will have to come through price increases. This is the fundamental setup that supports much higher silver prices in the coming years. Now, we need to talk about what might be the single most important dynamic in today's silver market: what's happening in China. Recent data coming out of China is absolutely remarkable. The Shanghai Gold Exchange spot price for silver has been trading at substantial premiums to Western prices. We're talking about premiums of $10, $15, even $20 per ounce above the prices quoted in New York or London. Let me be clear about what this means. When physical buyers in China are willing to pay $87 per ounce while the New York spot price shows $76, it tells us something crucial. The Western paper price doesn't reflect the true supply-demand balance for physical metal. The futures exchanges trade enormous volumes of paper contracts, but when you actually want to take delivery of physical silver, you discover that the real price is much higher than the paper price suggests. We're also seeing dramatic declines in silver inventories at Chinese exchanges. In recent weeks, tens of thousands of kilograms have been withdrawn from Shanghai vaults. This represents a significant percentage of total available inventory, and it's happening at an accelerating pace. Why is China accumulating so much silver? There are several reasons. Industrial consumption is growing as China's manufacturing sector continues to expand. China is the world's largest producer of solar panels, electronics, and increasingly electric vehicles. All of these products require silver. Investment demand is strong as Chinese citizens look for alternatives to a struggling real estate market and volatile stock market. Physical precious metals offer tangible value that can't be erased by policy changes or market crashes. There's also likely strategic accumulation happening at state or institutional levels. China understands that silver is critical for future technologies and may be positioning to ensure adequate supply. Here's something really important. China's silver market is experiencing backwardation. Backwardation occurs when the spot price exceeds the futures price. This is the opposite of the normal market structure. In a normal market, futures prices are higher than spot prices because you're paying for the convenience of deferred delivery. But in backwardation, people are so desperate for immediate physical delivery that they'll pay more for spot than for futures. Backwardation is a sign of extreme tightness in physical supply. It indicates that the market structure is under stress and that physical demand is overwhelming available supply. Historically, backwardation in precious metals has preceded significant price advances. It's a signal that the paper market is losing control and the physical market is asserting itself. The Chinese market is essentially setting a floor under silver prices. Even if Western futures traders try to push prices lower by selling paper contracts, physical demand from China will absorb any available supply at those lower prices and prevent significant declines. This creates an asymmetric situation, limited downside due to strong physical demand, but potentially unlimited upside as the supply shortage becomes more apparent. While everyone focuses on China, we can't overlook India's enormous and growing impact on precious metals markets. India has a population approaching 1.5 billion people. More importantly, hundreds of millions of Indians are entering the middle class for the first time in their family histories. As incomes rise, cultural traditions around gold and silver mean that demand is set to explode. Indian culture has a relationship with precious metals that goes back thousands of years. Gold and silver aren't just investments. They're integral to weddings, festivals, religious ceremonies, and family traditions. They represent stored wealth that passes through generations. As India's economy grows at a rapid pace, more families have discretionary income to allocate toward precious metals. This isn't speculative buying that will reverse at the first sign of trouble. This is cultural accumulation for long-term holding. Import data shows India bringing in massive quantities of silver. These imports aren't for industrial use or short-term trading. They're going into Indian households as jewelry, coins, and bars that will likely never be sold. Unlike Western investors who might sell during price spikes to lock in profits, Indian buyers typically hold their precious metals for life and pass them to their children. This metal is effectively removed from available supply. Bank of America's report emphasizes that gold continues to stand out as a hedge and alpha source. In investment terms, alpha means returns above what you'd expect from market movements alone. They're saying gold isn't just a defensive holding, it's an investment that can actively generate superior returns. That's a strong statement from a major financial institution. The fourth catalyst is what Widmer calls unorthodox fiscal policies. Governments around the world are experimenting with unprecedented levels of spending, debt monetization, and intervention in markets. Whether you think these policies are necessary or reckless, they create uncertainty about long-term currency values. When investors lose confidence in fiat currencies, they seek alternatives. For thousands of years, that alternative has been gold. Now, I want to address the elephant in the room. Gold and silver prices don't go up in a straight line. They're volatile, really volatile. Anyone who's invested in precious metals knows there are painful corrections along the way. Even in a bull market, you can see 20 or 30% pullbacks that make you question everything. That's just the nature of these markets. Widmer addressed this specifically in his research. He pointed out that gold bull rallies typically peak only when the underlying drivers that initially triggered the rally fade. They don't end simply because prices rise. In other words, you shouldn't sell gold just because it's hit a new all-time high. You should watch the fundamental drivers. Are central banks still buying? Is investment demand still strong? Are real interest rates still low? Are geopolitical risks still elevated? As long as those conditions persist, the bull market can continue even at seemingly high prices. Widmer also made a crucial point about where we are in this cycle. Despite the massive price gains in 2025, he believes we're not in a bubble yet. He stated clearly that he doesn't see the bullish environment ending anytime soon. This is significant because it suggests we may still be in the middle innings of this rally, not the final stretch. Several other major financial institutions share similar views. Goldman Sachs, one of the most influential investment banks in the world, projects gold at $4,900 per ounce by December 2026. JP Morgan forecasts prices heading toward $5,000 per ounce by late 2026. Morgan Stanley predicts $4,500 per troy ounce by mid-2026. State Street Global Advisors expects consolidation between $4,000 and $4,500 per ounce, but acknowledges potential for $5,000 due to strategic reallocations. When you see this level of consensus among major financial institutions, it's worth paying attention. What's particularly interesting is the reasoning behind these forecasts. It's not just one or two factors. It's a convergence of multiple trends all pointing in the same direction. Declining mine production, rising production costs, record central bank buying, surging investment demand, persistent inflation concerns, geopolitical uncertainty, unprecedented fiscal policies, historically low portfolio allocations to gold. Every single one of these factors supports higher precious metals prices. For silver specifically, you add the industrial demand component. The transition to renewable energy is creating massive new demand for silver. Solar panels use significant amounts of silver. Every gigawatt of solar capacity requires several tons of silver. With countries around the world committed to expanding renewable energy, this demand is only going to grow. Electric vehicles use more silver than traditional internal combustion engine vehicles. As EV adoption accelerates, that's more silver demand. 5G networks, consumer electronics, medical applications, all of these industries consume silver. The Silver Institute has documented that industrial demand for silver has been rising steadily for years. At the same time, silver mine production has been relatively flat or declining. Many silver mines are actually byproducts of copper, lead, or zinc mining. If those base metal operations slow down due to economic conditions, silver production falls, even if silver prices are high. This creates a supply constraint that's difficult to resolve quickly. Some analysts believe silver could be setting up for a supply crisis similar to what we've seen in other critical materials. When that happens, prices can go parabolic. We've seen this with lithium, cobalt, and rare earth elements. Silver has the added advantage of being recognized as money for thousands of years, so it benefits from both industrial demand and investment demand. That dual demand profile is extremely powerful. Now, let's talk about what this means for you as an investor or potential investor. I'm not going to sit here and tell you to put all your money into gold and silver. That would be irresponsible. Everyone's financial situation is different. Your age, income, risk tolerance, investment goals, and time horizon all matter. What I am going to say is this: if you don't have any precious metals exposure in your portfolio, you might want to seriously consider whether that's appropriate given current market conditions. Bank of America is a research suggesting 20 to 30% portfolio allocations to gold is aggressive by traditional standards. Most financial advisors would suggest something more conservative, perhaps 5 to 10% in precious metals as part of a diversified portfolio. But even a modest allocation can provide significant benefits. Gold and silver tend to move differently than stocks and bonds. When equity markets crash, gold often rises or holds its value. That negative or low correlation can reduce overall portfolio volatility and provide a cushion during market turbulence. There are multiple ways to gain exposure to precious metals. You can buy physical gold in silver bars or coins. Many investors prefer this because you actually own the metal. You can hold it, store it, and there's no counterparty risk. The downside is storage and security concerns. Plus, you'll pay premiums above spot price when buying and may receive less than spot when selling. You can invest in gold and silver ETFs, which track the price of the metals, but are easier to buy and sell through a regular brokerage account. These are more liquid, but you don't own physical metal. You own shares in a fund that holds metal. You can invest in gold and silver mining stocks. These offer leverage to metal prices because when gold rises, mining company profits can rise even faster. The risk is that individual companies can have operational problems, management issues, or other challenges that cause their stock to underperform even if gold prices rise. You can invest in precious metals mutual funds or mining sector ETFs to get diversified exposure to multiple companies at once. Some investors are even looking at newer options like gold and silver-backed cryptocurrencies or tokenized precious metals. These are still relatively new and carry additional technological and regulatory risks, but they offer features like divisibility and easy transfer that physical metals lack. Whatever route you choose, do your own research. Understand what you're buying, the costs involved, the risks, and how it fits into your overall financial plan. Talk to a qualified financial advisor if you're unsure. Don't invest money you can't afford to lose, especially in volatile assets like silver. One more important point. Timing matters, but not as much as you might think. A lot of people get paralyzed trying to find the perfect entry point. They wait for a pullback that never comes, or they buy right before a correction and panic sell at the bottom. If you believe in the long-term thesis for precious metals, dollar-cost averaging can be a smart approach. Instead of putting a lump sum in all at once, you invest smaller amounts regularly over time. This smooths out volatility and removes the pressure of trying to time the market perfectly. Let me share some historical perspective that might help frame your thinking. Gold was around $350 per ounce in the year 2000. By August 2011, it had reached $1,900. That's over 5 times higher in just 11 years. Then it went through a brutal bear market, dropping back to around $1,080 by December 2015. People who bought at the top in 2011 and held through the bottom lost over 40% of their value. That's painful, but if you held on, gold eventually made new all-time highs in 2020 and has continued rising since then. If you bought at the 2015 bottom, you've more than tripled your money by early 2026. The lesson isn't that you should buy and hold no matter what. The lesson is that precious metals are long-term holdings that require patience and conviction. If you're buying gold or silver because Bank of America says it might hit $5,000 or $300 this year, and you plan to sell the moment it dips, you're probably going to have a bad experience. But if you're buying because you believe in the long-term case for hard assets in an inflationary, high-debt, geopolitically uncertain world, then you can weather the volatility. Silver is even more volatile than gold. Silver can drop 30 or 40% in a matter of months during corrections. The same leverage that can send it soaring to triple digits can also send it crashing back down. If you invest in silver, you need to be prepared for wild swings. That's not for everyone. But for investors with higher risk tolerance and longer time horizons, the potential upside is substantial. Let me address some common criticisms of gold and silver investing because I want you to hear both sides. Critics often point out that gold doesn't generate income. It doesn't pay dividends or interest. That's true. If you hold a bar of gold for 10 years, you'll still have 1 bar of gold. It doesn't multiply. A company's stock can grow earnings, pay dividends, reinvest in growth. Gold just sits there. However, as Widmer pointed out in his research, from a pure directional perspective, gold has been one of the best performing assets over the past few years. Gold was up over 44% in 2025 alone by some measures. That's better than most dividend stocks or bonds. Another criticism is that gold has no intrinsic value. It's not useful like oil or copper. You can't eat it or burn it for energy. Its value is based on collective belief. But isn't that true of all money? The US dollar has value because we all agree it does, and because the government accepts it for taxes. Bitcoin has value because people believe it does. Gold's advantage is that it has been recognized as valuable across thousands of years in every human civilization. That's a remarkably persistent collective belief. Some people also argue that in a true crisis, gold won't help you. If society collapses, you'll need food, water, medicine, and security, not shiny metal. That's fair. Gold is not a doomsday prepping asset. It's a financial asset designed to preserve wealth through inflation, currency debasement, and financial system stress. It's not a replacement for practical emergency preparedness. Another concern is storage and security. If you own physical gold and silver, you need somewhere safe to keep it. Home safes can be broken into. Bank-safe deposit boxes have their own risks and limitations. Professional vault storage costs money. This is a real consideration, though ETFs and digital options eliminate this concern at the cost of not having physical possession. Counterfeiting is also a real issue in the physical precious metals market. There are sophisticated fakes out there. If you're buying physical metal, buy from reputable dealers, get proper authentication, and consider buying coins from government mints that have sophisticated anti-counterfeiting features. Don't buy gold or silver from random people online or at flea markets. Liquidity can sometimes be an issue with physical metals. And while gold and silver are globally recognized and traded, selling physical metal quickly at fair prices isn't always easy, especially in large quantities. Dealers need to verify authenticity, and you'll typically get less than spot price when selling to cover their costs and margin. ETFs and stocks are much more liquid, but come with their own trade-offs. One last criticism worth mentioning is that gold and silver prices are manipulated. There are ongoing debates about whether large institutions suppress precious metals prices through futures markets and other mechanisms. I'm not going to dive deep into those conspiracy theories, but it's worth noting that precious metals markets, like all markets, can be influenced by large players. Whether that constitutes illegal manipulation or just normal market dynamics is debated. For most individual investors, this doesn't change the fundamental case for owning precious metals as portfolio diversification. So where does all of this leave us? Bank of America's Michael Widmer has laid out a compelling case for gold reaching $4,538 on average in 2026, with potential to touch $5,000. He's identified multiple fundamental drivers that support this thesis, from supply constraints to central bank buying to investment demand. The analysis isn't based on speculation or technical chart patterns. It's grounded in real supply and demand dynamics, production costs, and macroeconomic factors. For silver, the case is even more aggressive, with potential targets ranging from $135 to $309 based on historical gold to silver ratios. Silver offers higher risk, but also higher potential reward. The combination of investment demand and growing industrial demand creates a powerful dual catalyst for silver prices. Multiple major financial institutions, including Goldman Sachs, JP Morgan, and Morgan Stanley, have similarly bullish outlooks for gold in 2026. This isn't fringe thinking. It's mainstream financial analysis from some of the smartest minds in the industry managing trillions of dollars. Does this guarantee these price targets will be hit? Absolutely not. Markets are unpredictable. Unexpected events can change everything. A sudden resolution to geopolitical conflicts could reduce safe haven demand. A rapid unwinding of inflation could change the narrative. Major central banks could unexpectedly stop buying gold. New mining discoveries could flood the market with supply. Any number of things could derail the bull thesis. But based on current fundamentals and the trajectory we're on, the odds appear to favor continued strength in precious metals. The structural drivers are in place. The investment community is paying attention. Retail investors are starting to allocate capital. Central banks are accumulating. Supply is constrained. Costs are rising. These are the ingredients for a sustained bull market. For anyone who's been sitting on the sidelines wondering if they missed the move, Bank of America's analysis suggests there may still be significant upside ahead. That doesn't mean buy blindly or bet the farm. It means take a serious look at whether your portfolio is properly positioned for the macro environment we're in. If you have zero precious metals exposure, is that really appropriate given inflation concerns, debt levels, geopolitical risks, and the potential for financial system stress? I want to close with a thought about mindset. Investing in precious metals requires a different psychology than investing in growth stocks or tech companies. You're not looking for the next Tesla or Apple that's going to 10x in 5 years. You're looking for wealth preservation and steady appreciation in an uncertain world. You're buying insurance against worst-case scenarios while still participating in upside if those scenarios don't materialize. That's a different game than swinging for the fences with speculative plays. The investors who do best with precious metals are the ones who understand this. They don't check prices every day. They don't panic when there's a correction. They view gold and silver as long-term cornerstones of a diversified portfolio, not short-term trades. If you can adopt that mindset, you're much more likely to successfully navigate the volatility and benefit from the long-term trends. Here at Bullion Logics, we're going to continue tracking these developments closely. We'll keep you updated on central bank buying, investment flows, production numbers, and any major changes to the thesis. Make sure you're subscribed so you don't miss any critical updates. Hit that like button if you found this analysis valuable. Drop a comment below with your thoughts. Do you think gold will hit $5,000 in 2026? What about silver? Are you bullish, bearish, or somewhere in between? I read every comment, and I'm genuinely curious to hear what you think. If you found this deep dive helpful, you might also be interested in our video on how to actually buy physical gold and silver without getting ripped off. We cover how to identify reputable dealers, what premiums are reasonable, how to verify authenticity, and the best strategies for storage. I'll link that in the cards above and in the description below. Remember, everything discussed today is based on analysis and forecasts from professional researchers and major financial institutions. It's educational information, not financial advice. Do your own due diligence. Understand your own risk tolerance. Make informed decisions that align with your personal financial situation. The precious metals market is at a fascinating inflection point. We've got record central bank buying, surging ETF inflows, tight supply conditions, rising production costs, and multiple major banks projecting $4,000 to $5,000 gold. Whether or not we hit those exact targets, the underlying trends suggest that precious metals deserve serious consideration as portfolio components in 2026 and beyond. Bank of America's prediction that gold will remain the primary hedge and performance driver in 2026, while silver could potentially more than double or even triple, creates an incredibly compelling investment narrative. Add in the fact that traditional portfolio allocations to gold remain historically low despite recent price gains, and you've got a recipe for potentially much higher prices if that allocation gap closes. The next 12 months are going to be absolutely critical for precious metals investors. We're either going to see Bank of America's bullish scenario play out, validating years of accumulation by patient investors, or we're going to see some unexpected development derail the bull thesis. My personal bet, based on everything I've researched, is that the structural drivers are strong enough to support continued price appreciation, even if we don't hit the most optimistic targets. Whatever happens, one thing is certain. Precious metals are back in the mainstream financial conversation in a way they haven't been since the aftermath of the 2008 financial crisis. Major institutions are recommending significant allocations. Central banks are buying aggressively. Retail investors are paying attention. The gold and silver story is no longer confined to hard money advocates and conspiracy theorists. It's become a legitimate mainstream investment thesis. As we move through 2026, keep your eyes on the key indicators. Watch central bank buying data from the World Gold Council. Monitor ETF flows and investment demand. Track mine production numbers and all-in sustaining costs. Pay attention to Federal Reserve policy and inflation data. Watch geopolitical developments. These are the factors that will determine whether Bank of America's forecast comes to fruition. Thank you so much for watching this deep dive into Bank of America's precious metals forecast for 2026. I hope you found it informative and thought-provoking. If you did, please share it with anyone you know who's interested in gold, silver, or investing in general. The more people who understand these dynamics, the better informed we all become. Until next time, this is Bullion Logics, reminding you to stay curious, stay informed, and stay strategic with your investments. See you in the next video.